Scope of inheritance tax, IHT. Inheritance tax is levied on the value of a deceased person's estate, including worldwide assets for UK-domiciled individuals. But from the 6th of April, 2025, domicile is being removed and replaced with a residence-based system. The tax also applies to certain lifetime gifts to prevent individuals from avoiding tax by transferring wealth shortly before death. This ensures the tax system captures both posthumous transfers and strategic lifetime disposals. Chargeable persons and transfers. Individuals are primarily responsible for IHT, with married couples and civil partners treated separately rather than as a single taxable unit. A transfer of value occurs when a gift diminishes the donor's estate, requiring both the intent to gift and a measurable reduction in the estate's worth. Business transactions at arm's length typically don't qualify as taxable transfers for inheritance tax. Thresholds and allowances. The nil rate band currently stands at £325,000, a threshold frozen since 2009 and expected to remain unchanged until at least 2030. An additional residence nil rate band of £175,000 applies when a main home passes to direct descendants, though this is gradually reduced for estates with a total value exceeding £2 million. This reduction operates at a rate of £1 for every £2 that the estate exceeds this threshold, meaning the relief completely disappears for estates worth £2.35 million or more. The residence nil rate band only applies to property that forms part of the death estate. It doesn't apply to lifetime gifts of property that later become chargeable because the donor died within 7 years, even if the property was a main residence when gifted. And it doesn't apply to property left in trust rather than being inherited directly by descendants. Key exemptions. Transfers between spouses enjoy complete exemption whether made during life or upon death. For gifting to anyone else, there is an annual allowance of £3,000 per year that can be carried forward 1 year. A small gifts exemption of £250 per recipient, and some marriage gifts, for example, up to £5,000 from parents are exempt. Regular gifts from surplus income also qualify for exemption provided they don't affect the donor's living standards. Tax rates and payment. Estates exceeding the nil rate band face a 40% tax rate on death, while lifetime transfers to trusts attract an immediate 20% charge. Taper relief progressively reduces liability on gifts where death occurs between 3 and 7 years after the transfer. Inheritance tax is due within 6 months of death, and lifetime transfer taxes are typically payable by the 30th of April following the tax year of transfer. Planning considerations. Effective IHT planning involves making gifts early to utilize the 7-year exemption period and maximize available allowances. Strategic will drafting can optimize use of the residence nil rate band, while generational skipping may reduce future tax burdens. The interplay between IHT and capital gains tax requires careful consideration when gifting appreciating assets during one's lifetime. While lifetime gifts can reduce eventual IHT liability if the donor survives 7 years, they immediately trigger capital gains tax when gifted if there is a gain, unlike transfers on death, which benefit from capital gains tax exemption. This creates a trade-off where gifting assets with substantial appreciation may incur an immediate capital gains tax charge, potentially outweighing the future IHT savings, particularly if the donor doesn't survive the 7-year period. Conversely, retaining assets until death avoids capital gains tax but risks the full 40% IHT charge if the estate exceeds available thresholds. The optimal strategy depends on factors such as the asset type, its growth potential, the donor's age and health, and available reliefs like business property relief, requiring careful analysis to determine whether lifetime gifting or retention provides the most tax-efficient outcome.